Nicole, is there anything you wanted to cover or finish up with before I
No,
dive?
I'm excited. You guys missed my big intro to this product line. This is a product line that we have had for quite a while, but it is really gaining traction here at IMES. If you do have any questions, I will follow up with each of you after the webinar, but I'll let Anthony explain what a great accumulation or income play this product is for your clients.
All right. Well, thank you, Nicole, and thank you for everyone. I know, when you dedicate some time out of your day to listen in regards to a new product offering, that certainly means something. So thank you for giving us your time here today. I'm going to share with you guys a little bit of background about Guaranteed Income Life Insurance Company. And just a little bit of background about myself. I've been in the industry for 16, 17 years now. I spent 15 years of my career with an index annuity carrier known as ING, and then they transitioned to Voya. And then I spent some time there on their mutual fund side as well. So, working with a large brand as ING and Voya was, transitioning now to a company like Guaranteed Income Life Insurance Company is definitely very exciting, and I'll kind of share with you here why. So this is a company that is growing rapidly, which is really exciting for for any producers or marketing organizations or even clients here in the industry. So we've been around for almost 100 years here at this point. The company was founded in Baton Rouge in 1926. Fast forward to 2016. Prior to 2016, we primarily operated in life insurance, MIGA business, some traditional fixed annuity business, and we had our asset-based long-term care product, the AnnuiCare. But in 2016, we did a whopping 45 million in new premium sales that year, and that's the year that we were purchased by our parent company, Couvert. Fast forward to 2021. We did approximately 900 million in sales, a little bit more than that. We just came up just shy of $1 billion in sales. We've diversified our product offering from just being a MIGA and life insurance company to now we do about 70% of our business in the fixed and index annuity space. The story behind Couvert is Couvert is a company that is looking to invest and grow in kind of the middle America market. Their first acquisition was Guaranteed Income Life Insurance Company. Their second acquisition was United Life Insurance Company, which is our sister company based out of Cedar Rapids, Iowa. And they began Couvert Reinsurance, which is located in Bermuda. And then in very end of 2019, they purchased a company called Lincoln Benefit Life, which is a well-known company out there in the industry that Couvert owns. So we're a company that's Guaranteed Income Life Insurance Company has doubled in sales 5 times over the last 5 years, which is just an incredible number. We're really working to put our shoulder into our fixed and index annuity products. And what I'm going to share with you here now about our WealthChoice line, which is our fixed and index annuity line, what you're going to see is an incredible product offering that we have, an extremely client-friendly product offering as well as an agent-friendly product offering to go along with it. So this is our product spec slide. I'm not going to spend a ton of time, delivering the product specs to you, but what I want you to know is that we have a 5-year version that issues up to the age of 90. We have a 7-year version that issues up to the age of 90, and then we have a 10-year version of the product. On the 7 and 10, we have a guaranteed withdrawal benefit rider that I'll talk about. That can be issued up to age 70, 75. One of the things you're going to notice about our products, and you've seen a lot of this, I'm sure, over the past really the past 5 to 10 years is you've seen more and more carriers really squeeze liquidity on a product to be able to get rate, right? Because we've been in such a low interest rate environment. This is a product that is still 10% free withdrawals on our index annuity products beginning in year 1 with no charge back to the rep if they take that 10% free withdrawal in year 1, and then 10% free withdrawals in every year after that. We also at no cost have a built-in return of premium rider on the product where 100% of the client's premium can be returned to them in the 6th contract year if they choose to elect that. So some really nice liquidity options available here on our products. If you look at our rates, we do have some of the top rates in the industry right now. The top 5-year S&P 500 annual point-to-point with a cap at 5.3%. The 7-year, we have a 5.4% annual point-to-point with a cap on the S&P 500, which is a really strong rate right now. There is a carrier out there that has a little bit higher cap than that, but again, what you're going to notice with them is that they've squeezed the liquidity. They don't have the liquidity features that we have in order to get the rate associated with that. On the 10-year product without a bonus, we are seeing a lot of play in the S&P 500 annual point-to-point with the 40% participation rate, and that's in the S&P 500. Aside from that, like our #1 use strategy is the Horizon Ascend. That's our volatility control index where you can get up to 100% participation on the 10-year, 80% on the 7-year, and 70% on the 5-year. I'll go over the Horizon Ascend. I think everyone here knows how the S&P 500 and annual point-to-point works, but I'll go over a little bit the Horizon Ascend in some more detail. But some really good stories here from Guarantee Income Life. So the 5-year product, pretty straightforward. Issues up to age 90, 10% free withdrawal starting in the 1st year. Surrender charges start at 10% and reduced by 1% every year. We do have a built-in death benefit feature where the beneficiaries will get 110% of their death benefit if taken out over 5 years. So that's a nice addition to the product. The income rider is not available here on the 5-year. But one of the things I really want to point out to you guys is on the 5-year, 7-year, and 10-year, all of our products have a maturity age of 110. And that's a really big deal. And before, when I worked for a carrier that didn't have we didn't issue business over the age of 80, like maturity age never really came up. But when you're writing business on people who are 90 years old, it is a really big deal to have a maturity age that kicks out to 110. More and more carriers are going to 100 now, but there are still a lot of carriers who have a maturity age of 95. And frankly, when the client is 90 years old, that's just too short of a term to have forced annuitization or take a lump sum distribution. The 7-year product is the same. It's the same as the 5-year product. You get a little bit higher rate. The only difference here on the 7-year product is that you can add the income rider to it. The 10-year product, you do have an optional 5% premium bonus that you can add on. There's no cost to that. This is a no-fee product. The only fee that would be associated with it is if you elect the income rider, which I'll get into here on the next slide. The only thing that the 5% premium bonus does is I'll go back to the rate sheet here. It does reduce the rates slightly, right? So you can get 100% par on the Horizon Ascend without a bonus. It's going to be a 60% par with a bonus. On the S&P 500, you can get a 40% par without a bonus. It's going to be a 30% par with a bonus. So the bonus is just an opportunity cost on that. I'll tell you, our income story is really, I think our accumulation story is fantastic. And this is really an accumulation product with just an awesome income rider that can be added onto it. But we're seeing a lot of play here in our income rider because of our exceptional competitiveness here with it. 90% of the cases that we have with the income rider are electing the 10-year product with the 5% premium bonus to be able to guarantee the most amount of income possible. So let me just kind of dive into how the income rider works here. You know, we don't have a roll-up on the income rider. We don't have a bonus to a benefit base. We don't even have a benefit base, right? Everything is based on the account value. What we have, or we just have some really, really strong withdrawal percentages. Now, you'll see carriers who, will, offer, I've seen 30% bonuses out there in the industry to the benefit value. And one of the things that they talk about when they do that is they add a 30% bonus to the benefit value to jumpstart income, right? Well, they don't really do it to jumpstart income. They do it to jumpstart the fees that are associated with it. And one of the things that we do that is really good and really client friendly that I don't think gets talked about enough is we're a 75 basis point rider fee, which is already one of the lowest costing riders in the industry. But everything with us is based on the account value, right? So up to the point where you turn the income on, it is a true 75 basis point fee. It's not a 75 basis point fee that is built on an inflated benefit value and then deducted from an account value. It's a true 75 basis point fee, which I think is really critical. One of the easy ways to understand what these withdrawal percentage riders are is it's always going to be 10% of the client's age, right? So a 50-year-old gets 5%, a 65-year-old gets 6.5%, a 72-year-old gets 7.2%, a 67-year-old gets 6.7%. The other thing we do is we don't decrease income for joint income payouts. The payouts are still going to be based on the younger spouse, but you'll see a lot of carriers where they'll decrease it further. They'll base it on the younger spouse, and then it'll be like a 50 basis point deduction. We don't do that. If you have two 65-year-olds, they're going to get the exact same payout as one 65-year-old will. The key here with this income rider is that it can't be turned on until year 4. But one of the things that we're able to do is, remember I said you can take up to 10% free withdrawals in years 1, 2, and 3. So one of the things where we're just this hidden gem in the industry is that we can actually calculate what income will be utilizing free withdrawals in years 1, 2, and 3, and then turning income on in year 4. And I'll try to explain that here the best I can using this case study with Frank and Lauren. So Frank and Lauren are both age 65, right? They want to retire and they want to take income immediately. Okay, they really like the idea that we are the only carrier out there in the industry that won't reduce income for joint income. So they love that. The only hang up that they have is that they want to take income earlier than year 4. So how do we do that? And if you call Nicole over at IAMS or anyone over there at IAMS, what they'll do is they'll likely use their calculator or contact me or the Guarantee Income Life sales desk, and we'll back into, okay, well, what can the client take out in years 1, 2, and 3 and still allow us to guarantee their income in year 4? And so what we do is we take these levelized free withdrawals in years 1, 2, and 3, and then turn the income on in year 4. And here's a quick calculator of what those percentages are, just to give you an idea. So in this example, we have Frank and Lauren, they're both age 65. So we go to the 65 age, and if they were going into the fixed strategy, that's going to guarantee a return of 1%. So we would take 5.93% times their premium of $100,000, and we would know that they could take out $5,930 in years 1, 2, and 3 on $100,000. And then when they turn income on in year 4, they're going to get that same amount, On the index side, since we're assuming a 0% return, because we're talking guarantees here, it's going to be 5.775%. And I'll show you how that looks on our illustration. So here it is on an illustration. We've got WealthChoice 10. We're using the 5% premium bonus. The clients are 65 years old, and they're putting 100% of their assets into the fixed rate strategy. So what we did was we backed into, okay, well, what will those free withdrawal amounts be? And we've got $5,930 in a free withdrawal in years 1, same thing in year 2, same thing in year 3, and then when we actually turn income on in year 4, they're guaranteed to get that same $5,930. In case, you know, any of you are keeping score at home, that right there is the highest income in the industry for a 65-year-old by about 10%. That's 10% higher than what any carrier out there is currently offering for a 65-year-old.
Before you move on, Anthony, real quick,
Yep.
I just want to point out to all of you on the call. Okay, so as you can see, you've all seen income quotes, and they all have a income base or a benefit base account or whatever that is ultra confusing to try and explain to your client how that income base and the bonus and the roll up and all of that works out. Okay, so not only are we offering here the highest payout to your client, we are offering you a very simple, easy to explain product to your client. And that's at least 75% of your sale right there. Being able to explain the numbers easily that are shown on the illustration you present. Okay, I'm done.
Nope. I mean, that's a really good point, Nicole. And I often joke, like, what's the, you know, what is the best thing about not having a benefit value? And the answer is that you don't have to explain what a benefit value is, right?
And explain that it's the monopoly money. This is your
Right.
monopoly money. This is your real money. Yes.
Yep. Exactly. And what you'll also notice here is this is, you know, this is assuming our minimum fixed rate of 1%, right? And so you're going to see the account value, since we are taking out more withdrawals than what we're returning, right? The account value is going to decrease slightly those first 3 years. But since we haven't turned income on, right, and the fees, like I said, are based on the account value, you're also going to see those fees decrease while we still haven't turned the income rider on, which gets back to my point that this is a true 75 basis point rider fee. In other carriers, what you're going to see is since the benefit value never goes down, right, even during a free withdrawal, you're going to see those fees locked in.
And they're like $1,300 as opposed to starting at $748. And notice that you do still have account value at age 82. And this is assuming we go 100% in the fixed account. So there is account value at age 82 as opposed to most income products that do run out of account value at 78.
Right. Correct. So this is the fixed rate strategy. You know, as far as our take goes, I would say about 25% of our income rider illustrations go into 100% into the fixed rate strategy, because what they're looking for is to maximize that guaranteed income. But I will show you this is assuming a 0% return in our index strategy. Okay, the reason this income is lower is because in the fixed rate strategy, we were at least assuming a 1% return. Okay, in this strategy, we're assuming a 0% return to the accumulation value. So in this one, this is still the highest income in the industry, right? It's just not the highest income by 10%. It's about the highest income by about 6% for a 65-year-old. So what we have here, and that's, I do want to preface that the 6 and 10 are on single. If you go to joint, which is actually what we were talking about here, it's more like, you know, 16 to 20% higher income compared to a joint income case. But for withdrawals here in this example, you've got 5,775 in years 1, 2, and 3, and then assuming a 0% index return, the rider benefit when they turn the income rider on is still going to be that same $5,775, which again, still the highest in the industry, and we're still assuming a 0% return. So the question I get asked all the time is, okay, so if we're assuming a 0% return here, what happens to the income if we get some positive return in our index crediting strategies? And this is what happens here. So we're still taking out the 5,775 because that's what we've calculated as what we'll need to take out to guarantee the income when they start it in year 4. But since we had positive returns in the rider benefit or in the index strategies, that income is going to step up to 6,535 when they actually turn it on in year 4. Keep in mind that this is based off of our hypothetical returns. So maybe it'll be 6,535, maybe it'll be a little bit more, maybe it'll be a little bit less. But one of the key things that I want you to take away from this is assuming that we get any positive return at all in years 1, 2, or 3, that income is going to be higher when they turn income on in year 4 than what they're getting for free withdrawals in years 1, 2, and 3.
Okay, we have a question. Hang on, Daniel. Okay, I wish I could make this box bigger, but I can't. So this product works best when taking income within 4 years. No, this product works best for anybody. What we cannot do is turn on immediate income on this product. So we utilize the 10% free withdrawal factor, figure out what that guaranteed income is going to be, pull that as a 10% free withdrawal, and then turn on the income rider in year 4. Does that answer your question? And then this product especially is, like we've mentioned, is going to be the highest payout. They do not reduce for joint. So even if your client has a 5-year age difference, it's still gonna be higher.
That's right, Nicole. So, you know, you guys should really be thinking guarantee income life insurance for any joint income cases. And you know, one of the disadvantages that we have with our rider, okay, and this is really important, and it's not a competitive advantage, it's a marketing disadvantage. So, you know, when 90%, 99% of this industry, when they're utilizing or when they're quoting income, what they're doing is they're going out to income illustrating softwares like Annuity Rate Watch, Annuities Genius are two of the biggest ones. And, you know, they're just plugging in the numbers and they're seeing what the highest guaranteed income amount is. You know, guaranteed income life, you really have to kind of peel back the layers of the onion here. And we don't show up on Annuity Rate Watch if you're utilizing this free withdrawal method because, well, you're not turning the income rider on, and Annuity Rate Watch assumes that you're turning the income rider on immediately. The other thing is other carriers, since they have these guaranteed roll-ups or huge benefits or bonuses to the benefit value, they're showing up higher for guaranteed income. But what you have here with us is we have the highest withdrawal percentages in the industry. But if you're deferring income out to, like, let's say year 5, 6, 7, you have to assume a little bit of interest, whether it's 2% or 3% interest. You have to assume a little bit. And when you do that, because our withdrawal percentages are so high, you're going to see our income jump up. So it's kind of like, would you rather have a little less guaranteed if you're deferring out that far, have a little less guaranteed to make a lot more if we do get some performance in the index? And it's not even that big of an if, because we'll get some performance in the index over a 5-year period. We're not going to have 5 years of zero.
Exactly.
All right, so what we ask everyone to do is we ask everyone to take the income challenge, right? And the reason we ask everyone to do this is, like I said, it's not, you have to peel back the layers of the onion for Guarantee Income Life. So next time that you're running an income illustration or you have an income case, call your partner at IMES. Let them work with Guarantee Income Life. You can call us as well, and let us kind of build a scenario for you and let you know exactly what your guaranteed income will be and show you what the upside of it will be, because it's such a fantastic story out there in the industry. And as far as like all things being equal, I've worked with a lot of index annuities. I've looked at a lot of our competitors. This is one of the most client-friendly index annuities out there in the industry. I think you will not be disappointed. I get asked all the time. The other thing I just wanted to throw in here is we have a marketing piece that actually should be developed here at the end of be done by the end of the day, ready to go to the field. And so Nicole, I'll shoot that over to you. But just
Perfect.
on a renewal rate history, if you're concerned about, okay, well, they have this great income, they have these awesome rates, I've seen this before, what are renewal rates going to go to? We have yet to reduce a cap or a par rate. We don't have spreads, so we have yet to reduce a cap or a par rate on renewals. One of the things we target is we target a stable option budget, which means that we're spending the same amount on call options every single year. So you can trust with Guarantee that we're going to keep those renewal rates as stable as they can possibly be. There's still outside factors that could affect renewal rates, but the fact that we're just reducing them for the sake of profitability and things like that, that's not going to happen here with us. So I'll get that out to you.
Thank you. I'm going to make a quick plug too. With April just around the corner, one of the 2 biggest CD renewal months of the year right now, Guarantee Income did raise their MIGA rates. Their products do issue through age 100, and we do have a high band 5-year rate at 3.25.
There it is. There's the rate sheet right there. So yeah, we will issue up to age of 100 on our
And
5-year
so,
product.
I mean, it was in an email I sent out yesterday, but if you do have somebody looking for a MIGA, this is the home for it as well.
Yep. And finally, the last thing I just want to cover here, Nicole, is on our Horizon Ascend Index.
Yeah,
So,
let's go over that because these people
okay,
on this call weren't on the last call.
gotcha. So the Horizon Ascend Index, we have, like I said before, the rates 70% on the 5-year, 80% on the 7-year. The 10-year without a bonus gets 100%. With a bonus gets 60%. So it's a really good accumulation story. And I've said it to you, Nicole, like I feel like these volatility control indexes really make my head spin, because everyone
Yep.
like they tout like how great theirs is, and that theirs is better than everyone else's. And I'm just going to be honest with you guys. So I don't have a crystal ball, right? And anyone who says that
You're
their index
gonna
is
see a 10% return off this thing. Baloney.
right,
That's what we say, baloney. You're
right.
gonna get 3 to 5, potentially 8 on a good year, and then you're gonna get 0.
Yep. What I can tell you here with ours is I can tell you just, how ours is different. And one of the biggest things is we have true diversification. You'll find a lot of volatility control indexes out there that tout diversification, but what they're really doing is they're diversifying amongst equities. and then they have their cash overlay. But equities, I mean, yes, some equities have more risk than others, right? But equities are going to be your most risky asset class. And what you want to find in a volatility control index is you want to find ways that that index, while reducing volatility, because most all of these have a target of 5% volatility, some have a target of 10% volatility, but while reducing volatility, how can they seek yield? And what I mean by that is if cash is their only way to reduce volatility, cash isn't making any yield. Okay, so hopefully I haven't lost you guys yet, but we diversify amongst 4 separate asset classes and 8 different ETFs. So we do have 3 equity ETFs, okay, which is good. But then we also have 3 fixed income ETFs. So you'll find some carriers and vol strategies that their fixed income component is treasuries. And we do have a treasury fixed income component, right? So we have that as well. But you're also going to have, our high yield corporate bond ETF. Okay, so high yield bonds are less vulnerable to a rising interest rate environment. And that's what we're in. So the fact that we're reducing volatility by going into one of our levers that we can pull is to allocate more into that high yield corporate bond means that we are still going to be able to seek return in the fixed income component during a rising interest rate environment where other volatility strategies might not. The fact of this diversification is automatically when you have an index that diversifies this much, we're never going to likely be the top performer on an illustration. It's not going to happen. But we can illustrate good returns and we can illustrate really consistent returns. Okay? And so what we have here in this index is we are displaying positive performance in this index 95.9% of the time. So over a rolling 10-year period, we have positive returns 96% of the time. I mean, that's unheard of among these volatility control indexes. And if you've used a volatility control index where, it's performed at 0% one year, and then the next year you get 8, and then it performs at 0 for a couple years, and then you get 12. That's kind of what we want to avoid here. We want to put runs up on the scoreboard, right? Returns up on the scoreboard year after year. And what we've been able to show is a 6.37% average annualized return. That's the index's return, okay? And in 2021, we had 4.1% return. This index is performed at over 5.9%, 50% of the time. It's performed over 5%, 60% of the time. So I have all the confidence in the world that 10 years from now, we can revisit this, and this index is going to match up pound for pound with any of the volatility control indexes out there. But what I feel comfortable going to you with is that you are going to see more consistent returns in this index versus other volatility control indexes because of our sheer diversification. We might not be the highest return every year, but we're going to get returns consistently in this index year after year. And just to kind of to drive home that point, this is a really bad annual point-to-point scenario, right? April 19th through April of 2020, where the S&P 500 was up for most of the year, right? And then first quarter of 2020, we had COVID, we had negative corporate earnings. The S&P 500 dropped dramatically. However, because we were still able to manage the volatility in this index, we were able to seek returns in our fixed income components, right? While equities were dropping, we were still able to seek returns during that. We were able to manage the volatility. We dropped by a little bit more than 1.5 points, but we still were able to deliver more than 5% to our clients during that period of time. And that's, I think, just a really telling story to manage, provide a more consistent, more predictable outcome for the clients.
The other thing I would say that we kind of didn't touch on is that in that index, the commodity is gold. So what happens when the S&P tanks? What happens to the price of gold? It goes through the roof. So there is a gold component as well to that index, which I think in these kinds of times that we're in right now is vital.
I completely agree. And if you have a volatility control index that's betting on one equity, right, with a cash overlay. So if you'll
Yep.
see, S&P 500 with a cash overlay is a
Yep.
popular one, right? Well, yes, that volatility control index is going to win when the S&P 500 is the best asset. That is going to show monster returns when the S&P 500 does extremely well. But what happens when the S&P 500 doesn't do extremely well?
Right.
So
And that's what we're trying to prepare your clients for. An index, if they choose this product for accumulation or if they choose it for income, we are trying to provide clients with a chance for that step up in income or a good, consistent annual yield from a good, solid accumulation play.
Yep. I think well said, Nicole. Do we have any other questions?
Nope, except I got a message about contracting, which I've answered. And I think, let me go through real quick. Yep. No, we do not have any more questions. Just know I will follow up with each of you after the webinar. I do have access to all of these marketing pieces that have been displayed. Anytime you do get a quote, take that income challenge. Give me a call. I am more than happy to show you how our product here at IMES will beat most anything that you are given. And if you want to look at it for accumulation, give me a call as well, because it's a great accumulation story too. And that is all I have got. Anthony, do you have anything else to add?
No, I think I just want to say thank you guys for your time today. Guarantee Income Life, we're one of the fastest growing annuity companies out there right now, and it's hard to, we've got the top cap rates in the industry. We've got the most consistent performing volatility control index in the industry. We've got top income in the industry. We've got really client friendly products. We've got really agent friendly products. It's a really good time to kind of be looking at Guarantee Income Life for some of your business.
I would definitely agree. And I would like to thank all of you too. I'll follow up with each of you after the webinar and we can get you out anything that you need. Thank you so much, Anthony, as well, for taking time out of your day. We do appreciate you being such a supportive rep to IMES. We certainly appreciate all that you do for us here and your instant responses when we need them.
Thank you, Nicole.
Have a great day, everybody. We will talk to you soon. Have a good weekend.